Hello everyone, and welcome to today's webinar hosted by the RIA and RIX Software, using data to make moves in a bad economy. My name is Holly Pels, and I'm with RIX Software and will be your moderator for today's event. We have an exciting and actionable webinar ahead for you today featuring the RIA's Terry Shallow and RIX Software's Jimmy Richburg. But before we get started, there's a few things I wanted to cover. Today's webinar will be recorded and will be made available to you after the event is over. For a better viewing experience, all lines are muted. If you have any questions, please feel free to ask them in the chat box in your webinar control panel. Due to time constraints, we will answer all of your questions via email following the webinar. I believe that covers all the small details, so I'm going to pass it over to Jimmy to introduce himself and get us started. Jimmy?
Thank you, Holly. Hello, everyone. My name is Jimmy Richburg, and I'm a solution consultant with RIX Software. A little brief overview about myself. I have been with RIX for about a year now. And prior to that, I was with Fleet Beat Sports for 4 years. I spent 2.5 years in the store as a footwear buyer and an inventory manager, and then 1.5 years at Fleet Beat Corporate as the RIX solution manager and a retail data analyst. A brief overview about RIX for those of you who may not be familiar with us. RIX is a software as a service cloud-based point of sale and inventory management system, and we have approximately 40 people with a variety of skill sets to help meet the needs of our clients. We do everything in-house here at RIX, from testing to consulting on our product, and we mainly focus on North American retail and apparel. Before we dive into the presentation, I'll turn it over to Terry Shallow from the RIA to introduce himself as well.
Good afternoon, everyone, and thank you for joining today. I really appreciate that. Again, I am with the Running Industry Association, and the RIA, as we're known now, is partnering with RIX because we feel that data sharing is a really important new tool for creating business efficiency and what we'd like to call the data sharing ecosystem. My goal as a brief introduction is simply to introduce you today to the key elements of that ecosystem and to let you know that we'll be partnering with RIX in Orlando at the running event, and at that event we're going to be providing you with more discussion and answering more questions during our roundtable discussions, and that'll be on Wednesday the 30th. So that said, just a brief overview of, again, what we're calling the data sharing ecosystem. And the first element of it is actually already pretty mature, and that's what we'll define as market intelligence. And what we mean here is that where POS data is aggregated to provide the channel with important information like, for example, market share data, average selling prices, and product trends and category trends. Again, we say that this is the most mature element of the data sharing ecosystem, given that market research has been ongoing for some time. Many of you are reporting to companies like Sports Marketing Surveys or NPD, Leisure Trends. There's several of them out there, and even RIX is participating now. But the point is to make the data more accurate and to make it more relevant, it's important that more of our retail members get involved with reporting. Now, there's very little downside to this, but a big upside is that when you participate, you get the results back for free. Vendors pay for it, but when you get it for free, it can help you make better product merchandising decisions. In other words, you're bringing in the right products that are trending in the marketplace that are relevant to consumers. So a good thing to point out here is that it's not limited to footwear. There's a great deal of data that's becoming available on apparel and accessory categories as well. So market intelligence is one piece of it. The second element of the data sharing ecosystem is actually going to be the focus of our conversation today, and that's centered around the idea of inventory management and product flow. Now, this is different than market intelligence because instead of access to aggregated data, what you're doing here is you're providing store inventory to a particular brand for a particular brand directly to that brand. So many of you may already be doing this by sharing inventory data with your vendors, And again, that places their reps in a position to better manage your future orders based on past sell-through data, as well as planning inventory levels to ensure that, for example, that you have the correct amount of inventory in your store when you need it and aren't left with excess inventory that binds your cash flow. So suffice to say, this is going to be a big part of the evolution of the channel going forward in terms of both an enhanced service model that your reps, I'm sure, are willing to provide for you, and also building higher levels of profitability, which is even more important. Again, we'll be discussing both of these elements of the data sharing ecosystem further at the running event, and I encourage all of you to attend. The first element of the data sharing ecosystem is pretty mature, market intelligent, but what we want to do is make sure that you're understanding to a higher level the idea of providing inventory feeds so your vendors can better help you manage inventory. And with that, thank you for your time, and I'm going to listen in and pass the mic back over to Jimmy. Thanks.
Thank you, Terry. So before we dive into the presentation today, we'll give you a brief overview of the topics that we're going to cover. We'll start off by talking about the current state of the retail industry as a whole. Then we'll look at some market insights from inside the run specialty industry, do an overview of some of our key performance indicators, how you can use those indicators in a buying and inventory management plan, and then do an overview of using data for customer engagement. So as we find in retail today, the landscape is changing dramatically. Many brands, big and small, are turning to data in order to help them create and drive business decisions within their retail locations and their online sales. But this change in the use of data is not just happening with larger brands and retailers. It's also happening with consumers as well. Our research shows that 72% of consumers are now comparing products online, 92% read online reviews, and 68% say that a positive review helps them trust a local business more. In addition to that, consumers are using up to 7 different channels before they make a final purchase, and 90% of purchases start online, but 75% end in store. So with both brands and consumers alike realizing the power of data, let's take a look at how you can use data within your store to help you drive your business. First, we'll look at how the run specialty market has been performing on a year-over-year basis. The data we have here is pulled from the run specialty stores we have in the RIC system. We have approximately 350 doors that categorize as run specialty, and this data is based on a sample set of those doors of 150. This is taken on a 12-month year-over-year basis from October 2014 through September 2016. Overall, we can see that the market is slightly down by 2.6% in overall units sold and 1.1% in dollars sold. Now, while it's easy to see how any type of negative or a decline can be a negative, the 1% is actually significantly better than other channels in retail, which we believe speaks to the type of customer service that's offered in run specialty stores, where customers can receive a personalized experience that you can't really get anywhere else. Next, we'll break into 3 of the major categories within the market and see how they're performing as well. And we'll start with footwear. So on a year-over-year basis, footwear is slightly up, being flat in units and up about 1.2% in dollars. Next, in apparel. This is the category that's seen the most significant decline on a year-over-year basis, with a decrease by 7.6% in units and 7.3% in dollars. One of the major contributing factors to this decline is the unseasonably warm weather we had during the winter months of 2015 and 2016. These warmer temperatures led to a decrease in cold weather gear being sold at the store level, ultimately contributing to the numbers that you see here. Within the accessory category, we also see a slight decline at 2.4% in units and 3.6% in dollars. This is another category that was also affected by those warmer months, where we saw a decrease in cold weather accessories such as hats and gloves. Now we're going to talk more about how you can utilize data within your business. An important factor we want to acknowledge as we go into this topic is knowing that access to data within your business is extremely high, and a challenge that many retailers face is not knowing where to begin in terms of what data to look at. Even further, once you decide on what metrics that you want to view and what's important to you, knowing how to interpret them and, more importantly, how to make decisions based off of them can also be a challenge. So today, we're going to focus on 3 key performance indicators, or KPIs. Those metrics are gross profit percentage, turns, and gross margin return on investment. We're going to look at what these metrics mean, how they're calculated, and what you can do to improve them to help you make decisions within your store. We'll start with gross profit percentage. This metric represents profit as a percent of your total sales for a given time period that you choose to analyze. And is calculated by looking at your profit dollars over your sales dollars for that period. We're going to highlight 2 ways that you can improve this metric. The first, by decreasing your markdowns, and the second, by selling more items with a higher margin. Decreasing your markdowns will ultimately increase your profit number, driving up that gross profit percentage. Also, selling more items that have a higher margin will also drive up that profit number, which will in turn increase your overall gross profit percentage. What we have here is a sample graphic that breaks out the margin that most retailers can expect on a $100 shoe, and where the cost of that shoe is being attributed. We know it, depending on the type of discount you may receive from a brand, retailers can expect anywhere from a $45 to a $50 margin on a $100 shoe. The second metric that we're going to review is turns, or inventory turnover. This metric represents the number of times you'll sell through your entire inventory in the course of 1 year. Before we go into this metric in more detail, there are a few important factors to keep in mind. The first is, this metric is meant to be viewed on an annual basis. So while you can view it for smaller timelines, you're always looking at it in terms of a year. Secondly, this metric is very subjective in that there are many different variables that can control it, as well as it's very dependent on how you choose to run your business. And we'll go into that in more detail as we talk through this metric. This metric is calculated by looking at your cost of goods sold over your average inventory value for a specified time period. One of the more common goal metrics for turn rate in the run specialty industry is a turn rate of 4 times per year, or roughly every 90 days. This is due to the fact that most footwear invoices are net 90, meaning that the invoice is due 90 days after the delivery date. Again, this depends very heavily on how you choose to run your business, but one way to think about it is, if you are significantly above a turn rate of 4, you may be understocked in certain products and potentially missing sales. If you have a turn rate significantly under 4, you may be overstocked in certain products. However, there are many retailers who prefer to keep their inventory very lean, in which case they have a very high turn rate, but they offset that with making sure that they have the right product for the customer in the store at all times. So let's review a few ways that you can improve or increase this turn rate metric within your store. The first is reducing your overall inventory value, and the second is to increase your sales volume. Reducing your overall inventory value will reduce your average inventory value for the time period that you're analyzing, ultimately driving up your turn rate. Increasing your sales volume, while it is easier said than done, will also decrease your average inventory value and increase your cost of goods sold over the time period that you're analyzing, which will in turn increase your turn rate. The third and final metric that we'll cover in this portion of the webinar is gross margin return on investment, or GMRI. This is by far the most important metric we'll cover and can also be the most challenging to understand. This represents, for every dollar that you invest in a product, how many are you getting in return? The reason this metric is so important is that it accounts for both profitability and inventory value in your business. So by looking at this one number, you can gain a lot of knowledge about the health of your business. This metric is calculated by looking at your profit over your average inventory value for a time period that you choose to analyze. Like turn rate, this metric is meant to be viewed on an annualized basis. So while you can view it on smaller time frames, you're ultimately looking at what your projected rate would be for a year time span. The two ways that we'll highlight to improve this metric are increasing your gross profit percentage and increasing your turns. Increasing your gross profit percentage ultimately means that you've increased your profit value for a given time frame, which will increase your gym rate value. Increasing your turn rate will lower your average inventory value, also increasing your gym rate. Another important factor to keep in mind when looking at how you can impact this number is seeing how all three of these metrics interact with each other, and knowing that you'd make a change to one and you can also affect the other. Because this metric is so important, we're going to do a sample calculation. We're going to look at the sales for a single vendor for a 1-month time period, and see how we can very easily calculate this number. So in this month, this vendor had $6,000 in profit and $16,000 in average inventory value. Because I've chosen to look at this for a month, I need to annualize this value out, and to do that, I'll multiply it by 12 to account for all 12 months of the year. Doing that gives me a gym rate value of 4.5. Now keep in mind, there are many different ways that this metric can be calculated, but this is one very simple way that you can do it within your store to help you gain this number about products and vendors. Now that we've had an opportunity to review these metrics, we're going to put them into practice in a real-life scenario that many retailers will have several times a year, and that is sell-in season. So it's sell-in season and you're preparing to sit down with your rep and plan your buy for a particular season. What can you do to best prepare for that meeting? As we go through this, we're going to look at data from a store from within our sample set that had an average yearly volume in comparison with the rest of the sample set, and we're going to focus on the footwear category. As you're preparing for this meeting, you want to be able to view vendor performance and product performance, and view this information on a 12-month period, as well as for a period of the season that you will be buying for. You also want to provide this information to your rep prior to the meeting. In the past, we know that there's been a lot of hesitation about the willingness to share data with your reps for fear of not knowing what they were going to do with that information. But as Terry highlighted, the importance of sharing data is more important than ever now. And what we've found is that over the past 2 years, there has been an increase in the education within the brand community on training the reps and how to effectively use the data that you provide them to help you make winning decisions within your business. So when you share this information with the rep, it is with the expectation that they are going to review that information and come to the meeting prepared to create a plan based around those data points. These sell-in meetings should be so much more than a show and tell or showing you everything that's in the bag. You want to view the new product line, specifically what's going to work well in your market, and then plan out your buy for that season. So to talk about how to apply these metrics in real life, we're going to look at some data from the store over a 6-month period and use these metrics to determine their performance and how we can utilize that information to plan the buy for the next season. So we will start with vendor performance, and in this example, we're going to focus on Brooks and New Balance. As we look at the data, we see that Brooks is clearly the top supplier over this time period for the store, outselling New Balance in terms of both units and in terms of dollars. So let's take it one step further and look at the metrics that we highlighted earlier in the presentation. Looking at their gross profit percentage and their gross margin return on investment, New Balance actually outperforms Brooks in both of these categories by 1.8% in gross profit and by $1 in gross margin. While this may not seem like a significant difference, had Brooks performed at the same profit margin for this 6-month period, it would have meant an additional $1,300 in profit for both the Brooks supplier and for the store as a whole. In addition to that, had it performed at the same level as New Balance did in terms of gross margin return on investment, they would have gained an extra $1 per every pair sold. What we can determine from looking at these metrics for both Brooks and New Balance is that New Balance had a greater return for every pair of shoes sold when compared to the Brooks vendor. So now that we have identified some of the performance metrics of Brooks, let's dig down even further to determine where the decrease in both of these two metrics occurred for this brand. If I'm looking at the turn rate, I see that for Brooks it sits at 3.8, right near that 4.0 mark. So I know that the inventory level is where I want it to be. What I'll do then is look at the markdown percent for both of these brands. As you can see, Brooks had a significantly higher markdown when compared to New Balance. So let's go down to the product level and see where the biggest markdowns occurred. Here we have a list of Brooks, the top performing products for Brooks over this time period. And we're going to highlight 3 in particular for this example. The first is the women's Ravenna 6. As you can see, the women's Ravenna 6 had a markdown percent of 24.5, giving it a gross profit percentage of 33.7. The second is the men's Adrenaline 15, which had a markdown percent of 38.5 and a gross profit of 24.0. And the third is the men's Ravenna 6, which had a markdown percent of 35.0, giving it a gross profit percentage of 25.8. What we can see from this result is that these products required heavy markdown in order to be sold. What you can do with this information is by looking at your historical data and your current year sales trends, you can plan on your buy for every month of the buying season. You want to work with your rep to create a plan around each month of the season and creating goals based off of that historical data and what you've been selling in the current year. Creating this plan will help you reduce the amount of excess inventory that you'll have at the end of a product life cycle, which often results in the markdown percentages that you see here. Because this factor is so important, we're going to talk about what a product exit strategy can mean in terms of the performance metrics of both products and the brands alike. For this example, we're going to use the same data that we used for the same store, and we're going to focus on the Adrenaline 15. So this includes all but men's and women's combined and all of the widths combined under one consistent style name. And let's look how this store utilized an exit strategy for this particular product. So over the 12-month life cycle of the shoe, the store averaged 40 pairs per month with an average of a 45% margin. On October 1st, 2015, there were currently 70 pairs left on hand. Now, looking at the sales trend of the year and the average performance of the shoe over the course of the 12 months, the store can assume that they would sell at most around 40 pairs over the month of October prior to the update, leaving them with 30 pairs of shoe at risk for being excess inventory. During the month of October, an additional 15 pairs were received. This is due to an additional discount offered by the brand to move some extra inventory. While this can be an effective strategy for increasing your margins on specific products, it's important that you have a plan for how you will sell those products when you bring them into the store. An extra discount is not enough of a reason to bring in an extra product when every product should have a purpose when bringing it in. On November 1st, the Adrenaline updated to the 16th version, and the store was left with 45 pairs on hand. So let's look to see what was required in order to eliminate the rest of those 45 pairs from the stock of this store. The time it took to sell through those remaining 45 pairs was an additional 11 months. meaning that it took almost an entire buying cycle of the next generation of the shoe to eliminate the previous version. Aside from the need to try and sell this product at whatever price a customer would take it, it also creates a confusing story for both the customer and for your sales associates. You have two shoes, different models, one at a discounted price and one not. Having those options makes it more difficult for the sales associate to sell to the customer and for the customer to understand what's really right for them. Over the course of those 11 months, the shoe earned a 22% margin, which is roughly half of what it was getting during the actual life cycle of the product. The important takeaway message for this section of the webinar is to understand the importance of what sharing can mean, what sharing of data and using your data to help you plan your buy can do for your business. It can be overwhelming to think that you need to create a plan for every SKU that you're going to carry from a particular vendor, but that's when you can leverage the power of working with your vendor to your advantage. While you may have 8 to 10 brands that you need to focus on any given buying season, your rep only has to focus on one. So use them to help you focus on a particular brand by looking at the data that you share with them, both from a historical standpoint and from your current year trends to help you create your plan. Doing so can help you drastically reduce the potential for excess inventory at the end of a product life cycle and ultimately save you inventory dollars, free up cash flow, and increase your profitability across all of your products. Now that we've had a chance to go through some of these metrics and view how we can apply them to a buying and an inventory management strategy, whether that's working with your rep and creating a plan around this information, we're going to shift gears a little bit and discuss how you can use data to help engage your customers in a positive fashion. The question you want to ask yourself in this situation is, how can you take something as impersonal as data and create a personalized customer experience? What we want to do today is highlight 4 potential strategies that you can use within your store to take data about your customer's purchase history and apply it to a positive personalized experience. The first strategy centers around training groups. Training group members tend to be some of the most loyal and frequent shoppers within your store. Being able to tag and track those customers separately from the rest of your customers allows you to run reports specifically about that group. From that information, you can create a personalized communication with your group, inviting them to come to the store prior to their goal race. And looking at their purchase history, you can create a personalized race bag to help create a more unique experience for each customer. An example will be looking at some of their nutrition product, providing the nutrition flavors that they purchased in the past within the bag, as well as some accessories and apparel in their size or similar to things that they have purchased in the past. This adds some personalization and uniqueness to each customer's bag and makes them feel like more of a unique experience. While this can be difficult to do for larger groups, it is a way to get started with it could be a way to get started with some of your smaller groups and ultimately a different way to engage your customers. The second strategy we'll go through is notifying customers of product updates. Many customers like to remain in the same shoe once they find one that's right for them. And they even like to know when that shoe updates to a new model. So reaching out to them and informing them that the shoe has updated to a new model and that you have their size in stock can encourage them to come into the store and try it on. A third strategy is emailing your customers when it's time to update their shoes. We know that most running shoes last for a period of about 6 months, so notifying a customer that it's time to update their shoes may encourage them to come back into the store. Including in this message which shoe they purchased and that you have their size available, and you can invite them in to try it on, can encourage them to come to the store and try them on and purchase them. Taking that a step further, you can even offer to mail the shoe directly to the customer if they can't make it into the store. While this does not get them inside the store to make the purchase, as we've seen from the market research we've looked at, consumers are increasingly looking for convenient ways to make purchases. by offering to ship it to them, you offer them that convenience factor and keep them engaged in your business rather than losing their sale to somebody else. The final strategy that we'll cover for this section is the idea of partnering with your brands to do an event for your top customers. As we've stressed throughout this webinar, the importance of partnering with your brands on a data level is important on a number of different valleys, from planning out products to engaging with your customers. You can identify your top customers within a particular brand and offer to partner with the brand to do an event for those customers, allowing them to try on new product, do new product lines, and offer some type of apparel or accessory or footwear. This keeps these customers feeling engaged and like they're a unique member of your community within the store. As a summary of what we covered today, we started out by talking about the state of retail and how both brands and consumers alike are shifting to a more data-driven model to using data to help them make decisions. We then took a look at what is happening in the running and specialty market, showing some year-over-year results and how it compares to other channels within retail. We did an overview of some key performance indicators, which included gross profit percentage, turns, and gross margin return on investment, how these metrics are calculated and how you can improve them within your business. We then took those metrics and looked to see how you could apply them to a buying and inventory management strategy and discussed the importance of sharing information with your rep and creating a plan for your current season around historical data and at the sale level and your current trends for this year in order to plan an effective buy and product exit strategy. We concluded by talking about some strategies around utilizing data for positive customer engagement, going through different ways that you can uniquely engage your customers to keep them interested in your business and keep them coming back. That is all I have for you. Thank you very much for listening in, and I am available for questions at any time if you want to talk in more detail about the topics we covered today.
Thank you, Jimmy. We wanted to thank the RIA for co-hosting this webinar, and especially Terry Shallow for joining us today. As Jimmy mentioned, he will be answering all of your questions, even the ones that you asked in the chat box, via email following this webinar. We also have recorded the webinar, so be sure to look for that in your inbox in the next couple of days. That has concluded our webinar for today, so thank you for joining us, and you guys have a great day.